A Business Loan Guide. Chapter 1. Business Loan 1. Business Loan Guide 1. In order to get a business loan, bankers want a feeling of trust and rapport with you. You almost never get a business loan if you're a startup. If you've been in business for 2 or more years, there's a chance they'll give you a business loan. What they want comes down to the following points. They like you personally, face to face. Your company is solid with neat balance sheets, income statements. They like a little bit of humility to butter up their egos. Your company has a good accounting firm, good current banking relationship, good insurance, and a good record of paying back previous loans. At some point you will probably need a business loan to expand, so keep a good credit rating in case you have to apply for one someday. The alternative, which a lot of people have done, is to save money from your profits until you have enough to expand, then you buy what you need. Refer to my money book for more information about your credit rating and loans in general, but for now, consider the following information. The banker is looking for your ability to repay the loan. To this end, he checks several things such as character. What sort of person are you? What is your track record for paying your debts? What are your exact intentions with the money? Where is your business plan? How honest and thorough is it? How feasible is it for this business to be successful? When do you plan to pay the money back? What collateral do you have? Will the loan be enough to make a significant improvement in your business such that you will be able to attract new customers? What's the outlook for your profession in general? Is there a real need out there that will continue? The loan officer wants you to be specific. Don't go in there saying you want about X amount of dollars. Have it all written up exactly how much money you need and exactly for what. There are several types of loans out there. Some of these are home equity loan. Loan made using your home equity as collateral. Credit card loan. You simply use your personal credit cards to get money. Line of credit. The banker authorizes that a certain amount of money be made available to you if and when you need it. This is an upper limit. You don't start paying interest until you actually borrow money up to your limit. This is often called the revolving line of credit. You borrow money when business is slow and pay it back when business is good. Many seasonal businesses like farms operate in annual cycles and work like this. Signature loan. If you have a good credit rating, you can get a signature loan using no collateral, just your signature, which is good enough for now to satisfy the banker that you will pay it back. They are usually short-term and carry high interest rates because you are not using any collateral. Cosigner loan. If you have a relative or good friend with considerable assets and a good credit rating who is willing to sign the guarantee for the loan to you, then you can get one of these loans. If you default, the creditor goes after the co-signer. You might even get a professional business person to co-sign for you for a fee of 1 to 4% with the condition that if you default, they get ownership of your business. Equipment lease or purchase. You might be able to make a deal directly with the manufacturer or distributor to receive equipment needed to run your business up front in either a sale or lease and pay on it monthly with interest with the equipment itself as collateral. This type of deal often requires a down payment of about 20%. Collateral loan. You put up something in collateral, either the building the business is in, business assets, equipment, vehicles, your house, your personal car, personal boat, etc. The lender will give you about 50 to 75% of what he or she perceives the assets to be valued at. Passbook loan. If you have a savings account, you can get a loan equal to the amount of money in the account with the creditor holding a lien on your account should you default. Life insurance loan. Use your life insurance policy as collateral to get a bank loan. You can possibly get a loan directly from the insurance company. Compare the interest rates. Business Loan Guide 2. Banks and other lenders have to operate by certain principles just as other types of businesses have rules. The fundamentals of borrowing are 1. Creditworthiness. 2. Kinds of loans. 3. Amount of money needed. 4. Collateral. 5. Loan restrictions and limitations. 6. The loan application. 7. Standards which the lender uses to evaluate the application. The ability to obtain money when you need it is an art form. Before a bank or any other lending agency will lend you money, the loan officer must feel satisfied with the answers to the 5 following questions. 1. What sort of person are you, the prospective borrower? By all odds, the character of the borrower comes first. Next is your ability to manage your business. 2. What are you going to do with the money? The answer to this question will determine the type of loan, short or long term. Money to be used for the purchase of seasonal inventory will require quicker repayment than money used to buy fixed assets. 3. When and how do you plan to pay it back? Your banker's judgment of your business ability and the type of loan will be a deciding factor in the answer to this question. 4. Is the cushion in the loan large enough? Does the amount requested make suitable allowance for unexpected developments? The banker decides this question on the basis of your financial statement, which sets forth the condition of your business, and on the collateral pledged. 5. What is the outlook for business in general and for your business particularly? Adequate financial data is a must. The banker wants to make loans to businesses which are solvent, profitable, and growing. The 2 basic financial statements used to determine those conditions are the balance sheet and profit and loss statement. The former is the major yardstick for solvency and the latter for profits. A continuous series of these 2 statements over a period of time is the principal device for measuring financial stability and growth potential. In interviewing loan applicants and in studying their records, the banker is especially interested in the following facts and figures. General information. Are the books and records up to date and in good condition? What is the condition of accounts payable? Of notes payable? What are the salaries of the owner-manager and other company officers? Are all taxes being paid currently? What is the order backlog? What is the number of employees? What is the insurance coverage? Accounts receivable. Are there indications that some of the accounts receivable have already been pledged to another creditor? What is the accounts receivable turnover? Is the accounts receivable total weakened because many customers are far behind in their payments? Has a large enough reserve been set up to cover doubtful accounts? How much do the largest accounts owe and what percentage of your total accounts does this amount represent? Inventories. Is merchandise in good shape or will it have to be marked down? How much raw material is on hand? How much work is in process? How much of the inventory is finished goods? Is there any obsolete inventory? Has an excessive amount of inventory been consigned to customers? Is inventory turnover in line with the turnover for other businesses in the same industry? Or is money being tied up too long in inventory? Fixed assets. What is the type, age, and condition of the equipment? What are the depreciation policies? What are the details of mortgages or conditional sales contracts? What are the future acquisition plans? Business Loan Guide 3. If you go to a bank and apply for a business loan, the bank will usually only loan you an amount equal to the amount you will be putting into the business. If you have $10,000 to finance a new business, but feel you would do better with $20,000, acquiring a bank loan should not be too much of a problem because you can buy business inventory and put that up as collateral. Make sure you have a good business plan, thoroughly researched and documented, with cash flow forecasts for the first 1 or 2 years of trading. Avoid a business loan unless you have half of the cash to match the bank's other half. If you have a good credit rating, you're better off applying for a personal loan than a business loan. Tell the bank that your loan is for a new car, home improvements, property repairs, etc. As long as you can satisfy the bank that you are a good credit risk and that your credit rating is in order, the bank will not particularly be concerned as to what you wish to do with your money, only that they can make a profit out of you and the money will be repaid in full according to their terms. If you're a crafty bugger and have a good credit record, you can apply for 6 or more small loans at different banks, but you have to do it all in the same day so the other loans are not on your credit record. When lenders check against your credit record, there will be no record of other applications other than the application you are making with that particular bank. Many small businesses are launched by the personal resources of their owners, but they can quickly reach the stage where the owner must look to the credit market for financial help in expanding operations. The banking industry is an important source of working capital. However, entrepreneurs may not realize that applying for commercial credit is a more customized process than obtaining consumer credit and requires a great deal of preparation by the business applicant. Commercial credit includes business loans. Here are some of the options. Short-term loans are one of the most common types of business loans and are usually for less than 1 year. They can provide interim working capital for a business temporarily in need of cash and are typically repaid in a lump sum when inventory or accounts receivable are converted into cash. Intermediate-term loans are often used for a business startup, the purchase of new equipment, expansion, or an increase in working capital. The maturity dates range from 1 to 3 years. Long-term loans generally are made for major capital improvements, acquiring fixed assets or business start ups. The term of the loan runs for periods of 3 to 5 years and is usually based in pan on the life of the asset financed. Repayment is usually made in monthly or quarterly installments. A line of credit offers you the ability to borrow money repeatedly, up to your credit limit, without having to reapply. A line of credit is particularly important to businesses that experience seasonal fluctuations. The lender generally will perform a review once a year, at which time the borrower is asked to provide updated financial statements. Applying for commercial credit can be tedious. It calls for a lot more documentation than when you apply for consumer credit. For lenders, extending credit to an entrepreneur usually means customizing the loan to suit the credit needs of that business, so don't be disheartened by the amount of paperwork needed to accompany the application. Be prepared. Among the best assets you can bring to the lender is a well-thought-out and documented business proposal. You need to clearly state the purpose of the loan. Will the money be used for temporary working capital, buying equipment, or expanding facilities, the amount of funds needed and for how long, and a repayment schedule. The repayment plan that tells how you propose to repay the loan or outlines a repayment schedule. The lender will be expecting you to repay the borrowed funds from the profits produced by the business. As a contingency, you might need to develop a plan on how you would repay the loan if the profits alone turned out to be inadequate. Supporting documentation will include copies of pertinent papers that support the information contained in your loan proposal, for example, a lease, certificate of incorporation, partnership agreement, letters of reference, contracts, invoices, or vendor quotes. Collateral can include business and personal assets such as inventory, equipment and accounts receivable, or real estate, stocks, bonds and automobiles. The business financial statement should be provided for the last 3 to 5 years of operation, including a year-to-date interim report. It should contain a balance sheet showing business assets and liabilities and a profit and loss statement showing revenues and expenses. The lender uses this information to calculate a debt-to-worth ratio for the business. Be prepared to provide copies of tax returns for the business for this same period. The personal financial statement should list your assets and your liabilities. Identify the names in which title to each asset is held and its fair market value. You may be asked for a list of credit references. Lenders will check your personal as well as your business credit rating. Lenders will carefully examine your financial statements and business projections. As a borrower, you must be fully prepared to answer questions about them. Personal guarantees of the owners or other principals usually are required even from an established business. The lender also may request another party's guarantee, such as a cosigner or a surety, or may request a government guarantee from the SBA or other government agency. In addition to the personal guarantee that you give, under the Equal Credit Opportunity Act, the lender is allowed to require another person's guarantee should your application fail to meet the lender's standards of creditworthiness. If all or most of the assets listed on your personal financial statement are owned jointly with your spouse or with someone else, the lender is likely to require such a guarantee, but the lender may not require that your spouse be the guarantor. In the case of secured credit, the lender is allowed to obtain a spouse's signature on certain documents when the applicant offers, as security for the loan, property that the two own jointly. In this case, the spouse or other co-owner may be asked to sign documents such as a mortgage or other security agreement that would be necessary under applicable state law to make the property available to satisfy the debt. Before you approach a lender, you might want to seek the advice of another, more experienced set of eyes to review your business proposal, particularly if you are a first-time borrower. By doing so, you'd be getting the loan package in shape to make it easier for the lender to reach a favorable credit decision. There are some business support groups whose members could counsel you on how your package looks. A qualified counselor might even discover that you really don't need more money and instead suggest better inventory control, improved marketing techniques or other changes that could actually solve your growth problems. One source of counseling available to small businesses is the Service Corps of Retired Executives, SCORE.org, which is sponsored by the SBA. Service Corps of Retired Executives, SCORE. 409 3rd St. Southwest. 6th FL. Washington, D.C. 20416. 800-634-0245. 202-205-6762. SCORE.org. A volunteer organization which pairs up a new business owner with an older seasoned vet who acts like a mentor and coaches him or her on all areas of the business. Others might include accountants and financial advisors. Once you are satisfied that your proposal is in good shape to present to a lender, set up an appointment to discuss your application. You will find that the lender can also be an excellent source of business and financial counsel. Most lenders are understandably conservative in granting business loans. Given the obligation to their stockholders and depositors, they need to be sure there's a good chance the loans they make will be repaid. If your application for credit is not approved, find out the reasons why. Some of the reasons that lenders often give for denying a business loan include insufficient owner's equity in the business, lack of an established earnings record, a history of slow or past due trade or loan payments, or insufficient collateral. Finding out the reasons may help you qualify the next time you apply. The lender will keep you informed about the status of your application. If you are considered a small business, business revenues $1 million or less, a lender has 30 days to let you know either orally or in writing whether or not you get the loan. The 30-day period begins after the lender has received all of the information needed to evaluate your credit request. If your application is denied, the lender must give you either a written statement of the reasons for denial or a written notice telling you of your right to obtain the reasons in writing. This notice may be given to you during the application process or at the time of the denial. The lender also will keep for 1 year the records relating to your application. Different rules apply for larger businesses, those with more than $1 million in revenues. Within a reasonable period of time after getting all the necessary information on which to base a decision, the lender must decide and let you know whether or not you get the credit. Then you will have 60 days in which to ask for a written statement of the reasons why you were denied credit. This is important to remember because the lender need not notify you of this right. The creditor will keep records of your application for at least 60 days after telling you of the credit decision. If you request that records be kept longer or ask for a written statement of the reasons for denial, records will be kept for 1 year. Obtaining credit can be a difficult process for any business owner and especially for first-time borrowers, but keep in mind that different lenders have different standards. If you did not meet the standards of a particular institution, you may still qualify elsewhere. If you have a full understanding of why the initial lender didn't approve your application, with time and more attention to these areas, you can improve your proposal as a result and may succeed the next time you apply. Kinds of money. When you set out to borrow money for your firm, it is important to know the kind of money you need from a bank or other lending institution. There are 3 kinds of money: short-term, term money, and equity capital. Keep in mind that the purpose for which the funds are to be used is an important factor in deciding the kind of money needed, but even so, deciding what kind of money to use is not always easy. It is sometimes complicated by the fact that you may be using some of the various kinds of money at the same time and for identical purposes. Generally, short-term loans are repaid from the liquidation of current assets which they have financed. Long-term loans are usually repaid from earnings. Short-term bank loans. You can use short-term bank loans for purposes such as financing accounts receivable for, say 30 to 60 days. Or you can use them for purposes that take longer to pay off, such as for building a seasonal inventory over a period of 5 to 6 months. Usually, lenders expect short-term loans to be repaid after their purposes have been served, for example, accounts receivable loans, when the outstanding accounts have been paid by the borrower's customers, and inventory loans, when the inventory has been converted into saleable merchandise. Banks grant such money either on your general credit reputation with an unsecured loan or on a secured loan. The unsecured loan is the most frequently used form of bank credit for short-term purposes. You do not have to put up collateral because the bank relies on your credit reputation. The secured loan involves a pledge of some or all of your assets. The bank requires security as a protection for its depositors against the risks that are involved even in business situations where the chances of success are good. Term borrowing. Term borrowing provides money you plan to pay back over a fairly long time. Some people break it down into two forms: 1. Intermediate loans longer than 1 year but less than 5 years, and 2. Long-term loans for more than 5 years. For your purpose of matching the kind of money to the needs of your company, think of term borrowing as a kind of money which you probably will pay back in periodic installments from earnings. Equity capital. Some people confuse term borrowing and equity, or investment, capital, yet there is a big difference. You don't have to repay equity money. It is money you get by selling a part interest in your business. You take people into your company who are willing to risk their money into it. They are interested in potential income rather than in an immediate return on their investment. The amount of money you need to borrow depends on the purpose for which you need funds. Figuring the amount of money required for business construction, conversion, or expansion, term loans or equity capital is relatively easy. Equipment manufacturers, architects, and builders will readily supply you with cost estimates. On the other hand, the amount of working capital you need depends upon the type of business you're in. While rule of thumb ratios may be helpful as a starting point, a detailed projection of sources and uses of funds over some future period of time, usually for 12 months, is a better approach. In this way, the characteristics of the particular situation can be taken into account. Such a projection is developed through the combination of a predicted budget and a cash forecast. The budget is based on recent operating experience plus your best judgment of performance during the coming period. The cash forecast is your estimates of cash receipts and disbursements during the budget period. Thus, the budget and the cash forecast together represent your plan for meeting your working capital requirements. To plan your working capital requirements, it is important to know the cash flow which your business will generate. This involves simply a consideration of all elements of cash receipts and disbursements at the time they occur. These elements are listed in the profit and loss statement, which has been adapted to show cash flow. They should be projected for each month. Loan based on collateral. Sometimes your signature is the only security the bank needs when making a loan. At other times, the bank requires additional assurance that the money will be repaid. The kind and amount of security depends on the bank and on the borrower's situation. If the loan required cannot be justified by the borrower's financial statements alone, a pledge of security may bridge the gap. The types of security are endorsers, co-maker, and guarantors. Assignment of leases. Warehouse receipts. Trust receipts and floor planning. Chattel mortgages. Real estate. Accounts receivables. Savings accounts. Life insurance policies. Stocks and bonds. Endorsers, CO makers, and guarantors. Borrowers often get other people to sign a note in order to bolster their own credit. These endorsers are contingently liable for the note they sign. If the borrower fails to pay up, the bank expects the endorser to make the note good. Sometimes, the endorser may be asked to pledge assets or securities too. A CO maker is one who creates an obligation jointly with the borrower. In such cases, the bank can collect directly from either the maker or the CO maker. A guarantor is one who guarantees the payment of a note by signing a guarantee commitment. Both private and government lenders often require guarantees from officers of corporations in order to assure continuity of effective management. Sometimes, a manufacturer will act as guarantor for customers. Assignment of leases. The assigned lease as security is similar to the guarantee. It is used, for example, in some franchise situations. The bank lends the money on a building and takes a mortgage. Then the lease, which the dealer and the parent franchise company work out, is assigned so that the bank automatically receives the rent payments. In this manner, the bank is guaranteed repayment of the loan. Warehouse receipts. Banks also take commodities as security by lending money on a warehouse receipt. Such a receipt is usually delivered directly to the bank and shows that the merchandise used as security either has been placed in a public warehouse or has been left on your premises under the control of one of your employees who is bonded, as in field warehousing. Such loans are generally made on staple or standard merchandise which can be readily marketed. The typical warehouse receipt loan is for a percentage of the estimated value of the goods used as security. Trust receipts and floor planning. Merchandise, such as automobiles, appliances, and boats, has to be displayed to be sold. The only way many small marketers can afford such displays is by borrowing money. Such loans are often secured by a note and a trust receipt. This trust receipt is the legal paper for floor planning. It is used for serial numbered merchandise. When you sign one, you 1. Acknowledge receipt of the merchandise. 2. Agree to keep the merchandise in trust for the bank and 3. Promise to pay the bank as you sell the goods. Chattel mortgages. If you buy equipment such as a cash register or a delivery truck, you may want to get a chattel mortgage loan. You give the bank a lien on the equipment you are buying. The bank also evaluates the present and future market value of the equipment being used to secure the loan. How rapidly will it depreciate? Does the borrower have the necessary fire, theft, property damage, and public liability insurance on the equipment? The banker has to be sure that the borrower protects the equipment. Real estate. Real estate is another form of collateral for long-term loans. When taking a real estate mortgage, the bank finds out 1. The location of the real estate. 2. Its physical condition. 3. Its foreclosure value and 4. The amount of insurance carried on the property. Accounts receivable. Many banks lend money on accounts receivable. In effect, you are counting on your customers to pay your note. The bank may take accounts receivable on a notification or a non-notification plan. Under the notification plan, the purchaser of the goods is informed by the bank that his or her account has been assigned to it and he or she is asked to pay the bank. Under the non-notification plan, the borrower's customers continue to pay you the sums due on their accounts and you pay the bank. Savings accounts. Sometimes, you might get a loan by assigning to the bank a savings account. In such cases, the bank gets an assignment from you and keeps your passbook. If you assign an account in another bank as collateral, the lending bank asks the other bank to mark its records to show that the account is held as collateral. Life insurance. Another kind of collateral is life insurance. Banks will lend up to the cash value of a life insurance policy. You have to assign the policy to the bank. If the policy is on the life of an executive of a small corporation, corporate resolutions must be made authorizing the assignment. Most insurance companies allow you to sign the policy back to the original beneficiary when the assignment to the bank ends. Some people like to use life insurance as collateral rather than borrow directly from insurance companies. One reason is that a bank loan is often more convenient to obtain and usually may be obtained at a lower interest rate. Stocks and bonds. If you use stocks and bonds as collateral, they must be marketable. As a protection against market declines and possible expenses of liquidation, banks usually lend no more than 75% of the market value of high-grade stock. On federal government or municipal bonds, they may be willing to lend 90% or more of their market value. The bank may ask the borrower for additional security or payment whenever the market value of the stocks or bonds drops below the bank's required margin. Lenders' rules. Lending institutions are not just interested in loan repayments. They are also interested in borrowers with healthy profit-making businesses. Therefore, whether or not collateral is required for a loan, they set loan limitations and restrictions to protect themselves against unnecessary risk and at the same time against poor management practices by their borrowers. Often some owners/managers consider loan limitations a burden, yet others feel that such limitations also offer an opportunity for improving their management techniques. Especially in making long-term loans, the borrower as well as the lender should be thinking of 1. The net earning power of the borrowing company. 2. The capability of its management. 3. The long-range prospects of the company. 4. The long-range prospects of the industry of which the company is a part. Such factors often mean that limitations increase as the duration of the loan increases. The kinds of limitations, which an owner-manager finds set upon the company depends, to a great extent, on the company. If the company is a good risk, only minimum limitations need be set. A poor risk, of course, is different. Its limitations should be greater than those of a stronger company. The limitations which you will usually run into when you borrow money are 1. Repayment terms. 2. Pledging or the use of security. 3. Periodic reporting. A loan agreement, as you may already know, is a tailor-made document covering or referring to all the terms and conditions of the loan. With it, the lender does two things. 1. Protects position as a creditor, keeps that position in as protected a state as it was on the date the loan was made, and 2. Assures repayment according to the terms. The lender reasons that the borrower's business should generate enough funds to repay the loan while taking care of other needs. The lender considers that cash inflow should be great enough to do this without hurting the working capital of the borrower. Covenants, negative and positive. The actual restrictions in a loan agreement come under a section known as covenants. Negative covenants are things which the borrower may not do without prior approval from the lender. Some examples are further additions to the borrower's total debt, non-pledge to others of the borrower's assets and issuance of dividends in excess of the terms of the loan agreement. On the other hand, positive covenants spell out things which the borrower must do. Some examples are 1. Maintenance of a minimum net working capital. 2. Carrying of adequate insurance. 3. Repaying the loan according to the terms of the agreement. 4. Supplying the lender with financial statements and reports. Overall, loan agreements may be amended from time to time and exceptions made. Certain provisions may be waived from one year to the next with the consent of the lender. Next time you go to borrow money, thrash out the lending terms before you sign. It is good practice no matter how badly you may need the money. Ask to see the papers in advance of the loan closing. Legitimate lenders are glad to cooperate. Chances are that the lender may give some on the terms. Keep in mind also that, while you're mulling over the terms, you may want to get the advice of your associates and outside advisors. In short, try to get terms which you know your company can live with. Remember, however, that once the terms have been agreed upon and the loan is made, or authorized as in the case of SBA, you are bound by them. If you need help in preparing your loan application, take a course for small business people at a local community college or visit your nearest SBA office to get assistance from a SCORE counselor, score.org. Apply for an SBA loan guarantee. The SBA is not a bank, but it does extend guarantees and may rarely participate in a loan when the bank is unable or unwilling to provide the entire financing itself. The SBA loan officer will ask you the same hard questions as a loan officer in a commercial bank and require the same carefully considered data on your personal finances, startup costs, and business projections. Increase your ability to get financing. You're selling yourself and you're selling the feasibility of your business plan. Put yourself in the other guy's place. If you were a lender/investor, would you invest in your idea? To show that you're serious, your business plan should show your income statements factoring in the fact that you intend to pay the loan off regularly with interest. Put in your personal credit history and management ability. Your equity in the business or cash investment in the particular asset being purchased. Include items of collateral. Be thorough but don't overdo the paperwork. Before you even try for a business loan, ask yourself if the business concept is sound and you're responsible enough to carry it through. Go over the following points. Is it a good business idea or can it easily fail? What about competition? What do you have for collateral? Do you come off as a serious, mature person or some young, naive punk spinning the wheel of fortune? Is your business plan a hastily constructed piece of crap or a work of art? Do you have a list of the exact things you need the money for? Do you have a schedule of repayment of the loan? Do you act like a dumb redneck or some jive turkey from the projects, or do you try to speak proper English and dress like any generic businessman would when going to a meeting? To get your credit rating up, a year or so before you need a loan, go out and get small loans and pay them off on time. In order to get a business loan, you have to come off like a responsible person, not just on paper but in person. Don't just walk into a bank asking for a loan. Make an appointment with the business loans officer. Take a look at yourself. Ask yourself, if you were a bank manager, would you give you a loan? Learn from your self-analysis. When you're in there, treat it like a formal presentation. Bring graphs and charts if applicable. Bring your business plan and be ready to talk about it. Bring samples of your products. Show pride in your business. He's checking you out, but you can check him out too. Shop around for the best banker for you. Be specific and to the point. Describe your business in 1 minute and state exactly why you need a loan. Be ready to answer his penetrating questions. If you can't answer them, don't jive him. Tell him why, that you don't have that information yet. Invite him to come see it anytime he wants, unannounced. Ask for more money than you think you need. Try to develop a rapport with the banker. Invite him over to your business. Ask his advice. Use the bank's educational offerings. If you have collateral, he will want to know, usually, your house and equity in the business. It might raise the probability of getting the loan. Ask him if he needs any additional information. Ask him when he can give you a firm answer. Introduce your banker to your lawyer and accountant. When rejected for a loan, don't give up. Keep looking. It's all about equity and proven track record. Most starting and growing companies have to borrow money and go into debt at some point in time, but the problem is that banks and other lending institutions are very conservative in general, even more conservative with a new or growing company, and often won't lend you money regardless of how great your concept or products are. What they're generally looking for is equity. What do you own in the business or even personally, your house and car, that they can plunder to get their money back should your business fail. Beyond equity, they want a proven track record of success over time. If you start your business and ask for a bank loan, chances are they won't give it to you, but 3 years later, if you've been selling a good amount of product and go in for a loan to expand, chances are you will get it even though you need the money less than you needed it when you were starting out. This is what is sometimes called the catch-22 of business loans. When you need the money, they won't give it to you because you're a risk. When you're doing fine and don't really need it, they want to lend it to you because they can make money off the deal. Look at it from the bank loan manager's point of view. He's used to several people a day every day coming in and shooting the hype about how great their business concept is. He makes money by lending money to people who will be able to pay it back with interest. The loan manager generally looks at you in terms of the 4 C's of credit. Character, past credit record. Capacity, business experience. Capital, ability to generate enough money to meet loan payments. Collateral, what can they get if the business fails? The truth is that more than half of all new businesses fail in the first few years. The best thing you can do for yourself is to make up a strong loan proposal over and above your business plan that leaves nothing to chance. A good loan proposal shows An understanding of your business. An understanding of market trends. A good management team in place. Strong accounting system in place. Realistic financial projections that show an ability to pay back the debt. Good relations with employees, distributors, and suppliers. How much money is needed and what it will be used for. The loan proposal should be something like a business plan with the following points. History of the company. Your request for money. Why you think you can make money in the real world. Financial information. Supporting documents. Chapter 2. Business Loan 2. The business loan application. Banks and other private lending institutions, as well as the Small Business Administration, require a loan application on which you list certain information about your business. Before you get to the point of filling out a loan application, you should have talked with an SBA representative or perhaps your accountant or banker, to make sure that your business is eligible for an SBA loan. Because of public policy, SBA cannot make certain types of loans. Nor can it make loans under certain conditions. For example, if you can get a loan on reasonable terms from a bank, SBA cannot lend you money. The owner is also not eligible for an SBA loan if he or she can get funds by selling assets which his or her company does not need in order to grow. When the SBA representative gives you a loan application, you will notice that most of its sections are self-explanatory. However, some applicants have trouble with certain sections because they do not know where to go to get the necessary information. Section 3, Collateral Offered, is an example. A company's books should show the net value of assets such as business real estate and business machinery and equipment. Net means what you paid for such assets less depreciation. If an owner-manager's records do not contain detailed information on business collateral, such as real estate and machinery and equipment, the bank sometimes can get it from your federal income tax returns. Reviewing the depreciation which you have taken for tax purposes on such collateral can be helpful in arriving at the value of these assets. If you are a good manager, you should have your books balanced monthly. However, some businesses prepare balance sheets less regularly. In filling out your balance sheet, remember that you must show the condition of your business within 60 days of the date on your loan application. It is best to get expert advice when working up such vital information. Your accountant or banker will be able to help you. The typical elements of a loan application are: 1. Cash sales. 2. Collections on accounts receivable. 3. Other income. 4. Total cash receipts. 5. Raw materials. 6. Payroll. 7. Other factory expenses including maintenance. 8. Advertising. 9. Selling expense. 10. Administrative expense, including salary of owner-manager. 11. New plant and equipment. 12. Other payments, taxes including estimated income tax, repayment of loans, interest, etc. 13. Total cash payments. 14. Expected cash balance at beginning of the month. 15. Cash increase or decrease, item 4 minus item 13. 16. Expected cash balance at end of month, item 14 plus item 15. 17. Desired working cash balance. 18. Short-term loans needed, item 17 minus item 16, if item 17 is larger. 19. Cash available for dividends, capital cash expenditures, and / or short investments, item 16 minus item 17, if item 16 is larger than item 17. 20. Cash available, item 19 after deducting dividends, etc. 21. Desired capital cash, item 11, new plant equipment. 22. Long-term loans needed, item 21 less item 20, if item 20 is larger than item 20. The lender also needs information about the kinds of insurance a company carries. The owner-manager gives these facts by listing various insurance policies. Once you have supplied the necessary information, the next step in the borrowing process is the evaluation of your application. Whether the processing officer is in a bank or in SBA, the officer considers the same kinds of things when determining whether to grant or refuse the loan. The typical loan processor looks for 1. The borrower's debt-paying record to suppliers, banks, home mortgage holders and other creditors. 2. The ratio of the borrower's debt to net worth. 3. The past earnings of the company. 4. The value and condition of the collateral which the borrower offers for security. The loan processor also looks for 1. The borrower's management ability. 2. The borrower's character and 3. The future prospects of the borrower's business. Refer to my money book for extensive information about CRAs and banks. When the business loan gets shaky. When you go through hard times, don't try to hide it from the bank. They can help you get back on track by offering advice and changing the terms. They want you to succeed because ultimately they want your money with interest rather than taking possession of the assets of a dead business. Every bank handles a problem business loan in its own unique way. Larger banks usually have special people to deal with it, while smaller banks will keep you with your original loan officer. Some banks hire outside firms to collect or sell the loan to a loan collecting company at a discounted value. If you're having trouble, hire a good attorney or certified public accountant who has some knowledge on how to deal with troubled businesses. In any case, it's not wise to lie to your banker or stay away from him. You have certain disclosure rules you have to live by, so if you start playing hide and seek, the banker will start to lose trust in you. Business bankers are tuned into how their businesses are doing because that's their job. That's all they do. They want to help you, so be straight with them. Some signs to a banker that you could be starting to falter as a business are as follows. Not reporting financial information on time. Not paying loan off on time. Not returning phone calls. Request for more money. Business owner suddenly seems aloof, moody, and troubled. Suppliers not getting paid on time. Change in management. Lawsuits against the business. Bad publicity. Excessive spending. Going to another bank for a loan which the other bank can easily find out through a credit check. Business deposit balance is lower than usual. Suppliers suddenly asking for a credit check before giving the business credit. Business cancels its insurance policies. Tax liens filed against business by the IRS. Business loses big accounts. General neglect of the business, i.e., not repairing basic things. Poor quality of products. Low sales volume. Customers returning merchandise. Poor employee morale. Get loans when you have almost nothing. If you have a good credit record, you can apply for 6 or more small loans at different banks, but you have to do it all in the same day so the other loans are not on your credit record. When lenders check against your credit record, there will be no record of other applications other than the application you are making with that particular bank. For this method, with $500, you open up a savings account at Bank A, then go to Bank B and ask for a loan using the bank account from Bank A as collateral. If they say why don't you just use that money, say I'm trying to build my credit rating up by getting a loan and paying it off in time. If they give you the loan, deposit the money in a new account at their bank, then go to Bank C and apply for another loan. Do this for 6 banks, pay the monthly loan fees off, and you will have a good credit rating within 6 months. With this first-class credit rating, apply for a credit card from these 6 to 10 banks with which you have already set up simple bank accounts so that they know you. If you want your credit limit to go up, make small purchases, then pay promptly every month. Once they see you are conducting your account in a satisfactory manner, increasing this limit will not be difficult. After several months, ask for a raise in credit limit. The worst that can happen is for them to refuse or suggest you continue with the credit card for a further period, after which they will review your limit. Once the credit limits go up on each card, you can borrow all that money on each card to finance your business or do whatever you want. Peer-to-peer loans / person-to-person loans / P2P loans / lending club. There are P2P websites where you put your situation and a credit report up, and a stranger might give you a loan that is not a gift. It's a legal loan. If you default, it will go on your credit record. Get a loan through alternative lenders for a lower interest rate than the banks charge. P2P loan websites. 4-small-business.com. cashmoneylife.com. cashmoneylife.com/peer-to-peer-p2p-loans-guaranteed. easyp2ploans.com. p2plendingnews.com. p2p-loan.paydayfastcashin.com. p2ploancorp.com. p2p-loans.com. p2pwealth.com. peer-lendingloans.com. peerlendingloans.com. peer-to-peer-loan.com. personalloanportfolio.com. prosper.com. Factoring associations. Factoring is a financial transaction where a business sells its accounts receivable to a third party called a factor at a discount. AmericanFactoring.org, American Factoring Association. sfnet.com, Secured Finance Network. Factoring.org, the International Factoring Association. Chapter 3. Loans in General. Loan Guide. Financial institutions want to make money, but more importantly, they want to minimize the risk of losing their money, which is why they check people out so carefully. Most people who want a loan are self-centered about it. They think that because they've been paying their bills for the past few years they have a good credit rating and the bank wants to lend them money because they will make money on the interest. While all this may be true, the bank is suspicious and conservative by nature, especially for a business loan or a loan for something frivolous. Even if you pay your bills on time, they have the ability to look for exactly when during the month do you pay your bill. Do you pay it promptly or do you wait until near the deadline? If you go past the monthly deadline, by even just a few days, that's considered a non-payment and goes on your credit file. Regular procrastination won't win you any points with them. The trade line is a summary of every loan you have ever taken out on your credit report that says how many times you were late paying your bills, the credit limits or the amount of the loan, the balances, monthly minimum payments, bankruptcies, if applicable, a credit rating for each loan and an overall credit rating. Loan officers are human beings. In addition to having a good credit profile, you still have to have the people skills to deal with these people, to be pleasant in a business-like manner and don't take liberties by being too personable with them. They want you to show respect for them. If you don't, they might not give you the loan just to spite you. In general, the more credit cards you have, the more credit card companies want to give you more because they think you're a good investment and want a piece of your money. If you pay your credit cards off regularly, the credit card companies generally raise your limits because they want to make more money off you. A little known feature of a credit report is the number of hits, that is, the number of people requesting a copy of your credit report, which signifies how often you're applying for credit, which could be bad because it could make you look like a credit junkie ripe for bankruptcy. If you are rejected for a loan, your best bet is to try to find someone who will be a CO borrower as opposed to a CO signer, because the CO borrower is directly responsible for the money. The CO signer agrees to pay if you default, which is not as strong a commitment to the bank as the CO borrower. Some bankers use a formula whereby they calculate how much of your income you use to pay bills for your house. If it's more than 40%, it's too high for them and they will reject you. An equity loan is a situation where you put up 50% or more of the money of what you want to buy, house, car, etc., then ask for a loan. If you default, the bank gets the asset you borrowed the money for. Even these loans are not automatic. You still have to prove to the bank that you have enough incoming money to make monthly payments. In essence, when applying for a loan, the major things the bank wants are: a record that you have paid debts in the past, proof of a steady income, namely through steady employment. Before you sign for a loan, do the math on the interest rate to find out if it's true or if there's some kind of error. Do it with a loan calculator or accounting software. Find a friend who knows how to do the math, get a book at the library that shows you how to do it, number 332, or hire an accountant for a few bucks to figure it out for you. There's simple interest and compound interest. There are financial calculators on the market that do it for you. Be wary of all loans. They have many tricks to try to inflate your fee. Ask about all charges. You must check the numbers for yourself. I guarantee that you will be overcharged in many cases by their so-called innocent errors. The federal government has enacted the Truth in Lending Act, which means that the lenders must disclose the true APR on your loan contract clearly with all loan costs included into the equation. If you fall for a down payment ploy or delayed payments, you will end up paying more in the long run. If you get a bank loan for something like a boat or a car, many banks have a clause whereby if your insurance on these vehicles lapses for any reason whatsoever, the insurance company notifies the bank who provide insurance on your vehicle from their blanket policy and slap an extra fee onto your loan. Read your contract. Tide selling is an illegal process of a banker offering you a loan on the condition that you move your bank accounts, mortgage, investments, credit cards, and all other financial affairs to their bank, but it's not illegal if you offer to do it if you think it will increase your chances of getting the loan. Types of loans. When you apply for a loan, the lender will check your credit rating, and if you pass, you will usually get an unsecured loan where the power of your signature is good enough, but sometimes they might ask for collateral, or you could offer collateral in order to get a higher loan than you would without it. You can offer stocks and bonds or other securities as collateral, in which case you can usually borrow only 50% of what they're worth. A collateral mortgage usually means you are using real estate property as collateral, while a chattel mortgage means you are using something that moves like a car, truck, boat, plane, etc. If you don't pay on the loan on time, the lender can take possession of your collateral and sell it to recoup the cost of his loan. Installment loans are the traditional loans you usually get at a bank or credit union for a set number of dollars at a set interest rate for a specific reason, like to buy a car, furniture, new baby, etc. A demand loan might look like this, except that the lender has the option to call it in and demand full payment whenever he wants, and the borrower has the option to pay it all off whenever he wants, as opposed to steady monthly payments which the lender wants because this is how he makes the most money off you. Retail installment contracts are credit agreements for such major purchases as an automobile, where the buyer agrees to make monthly payments directly to the dealer or manufacturer at a high interest rate, of course. Many stores offer their own financing for the products they sell, like furniture stores and electronics stores. A layaway plan is when you make payments on a product and don't get it until it's all paid off. If the company goes out of business in the midst of it, you're out of luck. The seller usually likes to hijack the buyer at the tail end of it and demand more money. If a buyer cancels at some point during the payment phase, the seller can't keep any more than 20% or $500, whichever is less. The only good thing about layaway is that it can help you build up a credit rating. Other than that, if you want to save for something, put your money in the bank where you will get some interest on it. Credit card loans are discussed elsewhere. You can borrow from your credit card at high interest rates. Mortgage loans are loans to buy a home. The government has several loan programs for citizens in different areas like business, Small Business Administration, SBA.gov, student loans, ED.gov, and housing and urban development, HUD.gov. The different types are direct from the government and guaranteed/insured, where the person gets a loan from a private insurer which the government guarantees. There are also several other hybrid programs. You can get loans against your retirement pension plans. Some banks will give you a secured consumer loan collateralized by assets such as certificates of deposits or stocks and bonds. You can get loans on your life insurance policy at low interest rates, especially if you have had it for a long time. If you can join a credit union either through your company or another way, the benefits are generally better than banks, and the interest rates on loans are a few points lower than other financial institutions. Some credit unions will open an account for almost anyone with such loose criteria as you have to have attended a community college or worked for the government at some point in time, so call them up on the phone to see if you can open an account there rather than at a bank. If you have a good credit rating, you can get a signature loan based on your signature alone. As long as you pay it back in time, you can usually raise your credit limit on request. Probably the best deal around when it comes to getting a personal loan are the brokerage houses. Although they don't advertise, many will lend you a certain percentage of the value of your investment account with them, generally around 50%. So if you buy stocks and bonds with a brokerage house and you suddenly need a loan, you may not have to liquidate to get it. They will lend it to you and the interest is deductible if you pay it monthly instead of letting it accumulate. When shopping for a loan, look for a loan officer who's commissioned, meaning that he gets a commission for every loan he signs, therefore he will be more eager to give you a loan over just a salaried officer. Buying credit life or disability insurance when getting a loan are a waste of money. Many banks offer loans online. Refer to the section about online banks and punch the word loan into search engines. Deal with loan officers. Have a good reason for requesting the loan. The likelihood of you repaying a loan for a trip to Europe is not as great as that of you repaying a loan for home improvements, a business venture, a real estate purchase, etc. Prove to the loan officer that your reason for requesting a loan is good and that you are not a high risk. Be honest when the loan officer asks you about your finances, but don't say more than you have to. Don't get angry with the loan officer. He may say no today and yes tomorrow. Be confident and optimistic at all times. Agree with the loan officer on as many issues as you can. People don't like to hear the word no. If you must disagree, use this sales technique. Yes, I understand what you're saying, but... Be calm and collected at all times. Don't be afraid of the loan officer. You will be doing as much for his institution as he will be doing for you. Being afraid will only make you nervous and jumpy. Know as much as possible about the loan before you apply for it. This will put the loan officer on the defensive. Be well dressed and groomed for the interview. Be open to any suggestions or criticism and try to see the situation from the loan officer's point of view. Try to get an officer who works on commission so that he will be more motivated to give you the money. Apply for a loan. The proposal you submit for your loan will determine whether or not the banker will give it to you. Expect the following questions at a bare minimum. How much money do you want? What's your plan with the money? Why do you think this money'll help you get more profitable? When will you pay it back? What happens if your plan doesn't work out? The following formula will show you how to apply successfully for a loan. Cover page. On this page, include your name and address and the names and addresses of any others who are applying jointly with you. This page goes on the front of the loan request and it should contain the title of your request. Letter of request. This letter may be the most important part of your loan request and it will determine if you get the loan. The letter must get right to the point and tell the loan officer exactly what he has to know in 1 or 2 pages. The letter should tell the officer 1. Why you want the loan. 2. How much capital you want. 3. How you propose to pay back the loan. 4. Any personal information that may help you get the loan. Credit application. You may obtain a credit application form from any lending institution. Data sheet. This form, similar to a resume, is very helpful to the lender. It contains background information about yourself and all your personal information, such as name, address, height, weight, marital status, birth date, etc. It also includes information about your past 4 jobs, 3 references, and a complete record of education. Marketing plan for business venture. If you try to get a loan for a business venture, this part of your proposal is one of the most important. The function of the marketing plan is to show the lender what you will do with the money loaned you and how you will pay it back. The marketing plan proves to the lender that you will make a profit. The following 6 steps should be taken when creating your marketing plan. If you have trouble, contact your local SBA office for assistance. 1. Analyze your present marketing situation. In order to project your company's future achievements, you must know where it stands at the present time. In this portion of your marketing plan, analyze your company's financial resources, competitive strengths and weaknesses, organizational setup, market conditions, experience, management capabilities, clientele, channels of distribution, how you will distribute your product, and your competition. To determine your marketing objectives. This step provides guidance and direction for your company. Here, you tell the lender exactly what you want your company to achieve. But remember to be specific and make sure that the numbers can be measured, such as, increase the market share of widgets 10% from January 1st to December 31st. You do not have to know these numbers precisely, but you should make a rough estimate of what your company can achieve. 3. Assess your company's capabilities. In this step, show the lender how you will use your resources to reach your objectives. You must show that you have every resource necessary to reach your objectives, except one, a certain amount of money. In this step, explain past experiences and accomplishments that you, your company or other company officers have had that could aid the future of your firm. Also mention anything favorable in step 1 that may help you reach your objectives, such as your clientele, receivable, equipment, etc. 4. Create a marketing strategy. In this step, show the lender your plan or strategy for meeting your objectives. This may include continuation or revision of an existing strategy or be completely different strategy. A strategy is a complete plan of how you will best use your resources to meet your objectives. List each activity you will perform. It is also important to establish which duties or activities will be delegated to which person. 5. Put your overall plan on a time schedule. In this step, place the activities you have listed in the previous step on a time schedule. List each activity and show how long it will take you to complete. You should also show beginning and completion dates. Do this with all your marketing activities. The lender not only sees what you plan to do but how long it will take you. 6. Control and evaluate your plan. You should have a method of evaluating your process as you follow your plan. You should be able to control all the proposed activities and make sure they are on schedule. For examples, if your objective is to obtain 300 accounts within a 10-mile zone, your control activity will check that you have done just that. The control activity will be a monthly record of the number of accounts you have obtained within the designated 10-mile zone. Financial statements. Personal financial statements of all persons involved in the business venture are important to the lender. Current as well as projected financial statements should be included in the loan request. Projected financial statements are statements that show how predicted sales will affect future financial conditions. It is advisable to have an accountant help you prepare your statements. Statement of capital expenses. This statement shows the lender exactly what you plan to do with the money he loans you. You should itemize how each dollar he lends you will be spent. Real estate loans. Having a professional, independent appraisal of the property is the first requirement. If possible, include pictures of the property as well as maps showing its exact location. Turned down for a loan. If you are turned down for a loan, find out why. It's your right. Request your credit report and be sure it is accurate. Correct any errors on it. By studying your credit report, you should be able to find out why you were refused. Work on your weaknesses and try again for another loan. Don't give up until you get a loan. If you have done all you can to improve your credit rating and are still unable to obtain one from your bank, consider these options. A credit union loan. Often they are easier to get than loans from a bank and the interest is sometimes lower. A source other than your bank. Often other lending institutions have less rigid qualifications for loaning their money, like household finance and beneficial finance. Interest is usually higher though. A cosigner. Often you will get a loan if someone with a good credit rating cosigns your application. Chapter 4. A loan website guide. Major business loan websites. business.gov/finance/financing/loans, small business financial assistance. Bankrate.com. List of commercial lenders. allbusiness.com. allbusiness.com/articles/starting business. business.com. businessfinance.com. businesslenders.com. businessloan.com. businessloan.org. businessloans.wealthygeek.com, Directory of business loan deals.